While you might have looked at tonight's result on the S&P 500 being down just a skosh and thought to yourself it was a pretty quiet day, the truth is we actually had a pretty decent range from high to low, providing some interesting intraday opportunities for those of you who were a little bit more nimble. Now, despite that, we did end up seeing that all four of our U.S. equity indices did touch a new 52-week low at one point during the day. And so our postures do remain bearish for now. We're still waiting for some sort of a big washout where we have a catalyst that pushes the markets back towards those moving averages. And we just haven't seen the catalyst materialize yet in the form of a spiking VIX. So we'll talk about all of that and see what it means for our various postures. Be aware that we do have bearish postures not only across the main indices, but across all of the sectors at this moment in time as well. And then we'll get into a discussion about sold puts and how that particular bullish strategy has held up reasonably well during these bearish conditions. And I'm going to provide 3 different reasons for you as to why we've found success in tonight's video. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 12th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area underneath the video. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. And you'll also be given a heads up as to what stocks in the S&P 500 are giving you overbought and oversold cluster signals. Some of you saw that when I was doing the video on Tuesday. We had, I believe, 111 or 112 stocks out of the 500 stocks in the S&P 500 with oversold cluster signals. So that can be quite enlightening to read through. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. I really appreciate those of you that click like and retweet on these Market Outlook related posts as well. And then last but not least, we do have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. It ended up being a little bit of a quiet session, at least that's the way it looked at the end in terms of gains and losses, but there was actually a fair bit of volatility between the open and closing bell here today. Here's how things shook out. You can see it was a bit of a split difference here today in regards to bulls versus bears. Naturally, that happens on days like today where we were basically just flat as our end result, so about half the stocks up, half the stocks down. You will notice that Microsoft and Apple both closed in the red here today. Apple had some interesting news here recently in that they lost the moniker of world's best or biggest publicly traded company. Apparently, Saudi Aramco has now taken over the crown for world's largest publicly traded company, with Apple taking a hit here with the rest of the tech universe in recent weeks. Remember, up until this past couple of week period, Apple had been a stalwart and had been hanging in there. It does make me wonder what's going on in Omaha right now. When I was back at the Berkshire Hathaway event a couple of weeks ago, Buffett specifically said that he was buying some shares of Apple, I think it was in February, and the only reason he stopped buying it is because Apple's stock stopped falling. And where Apple is actually trading right now is lower than where it was trading in February. So it does make you wonder if Buffett is starting to get a little bit more interested in adding to their exposure in that particular name. So only time will tell. Remember, we will get the 13F filings coming out here quite shortly, within another week or so. But that 13F time period only covers the first quarter. So basically anything that would have been done from January through March. And then there's a 45-day window until those institutional investors and big money managers like Buffett and everybody else have to report that. And so we will learn from Berkshire Hathaway and Buffett what they were doing in the first quarter. And we do have a hint of that in regards to some of the things they've stated in regards to Chevron and Hewlett-Packard and Occidental Petroleum. And we'll probably learn the exact amount of Apple. But anything that he's done basically since the end of March, he wouldn't then have to report until the following quarter. So kind of left in limbo there in the short term. Nonetheless, with such a huge cash hoard at Berkshire Hathaway. Remember, it's $100 billion plus. There is a possibility that they are shopping in these more difficult times for the rest of the mere mortals out there that are suffering through losses. As you can see, Alphabet also closed lower here today, as did Berkshire Hathaway. Speaking of which, they were down over 1% here today. You found that Nvidia was down about 3%. Tesla continues its slide. It was down not quite 1%, but it's been a pretty ugly spiral lower for Tesla as well, especially since Elon Musk has reported his intention to buy Twitter. There is some fear, as we've been mentioning along the way, that Tesla shares could be involved in some of the collateral or possibly be used as a source of funds. In other words, perhaps Elon would need to sell a few shares in order to finance the Twitter deal. And so I think that's kind of thrown a big wet blanket on the enthusiasm around Tesla here in recent weeks as well. Now, in terms of the winners here today, our big large cap winner today would have been Amazon. You can see it was up 1.5%. Now, keep in mind, Amazon has been crushed in the last month or so. So to only go up 1.5% is not that big of a deal. But in terms of how large the company is, in terms of how big these squares are, this is the biggest square that managed to close higher here today. Not too far behind it was Facebook. It was up about 1%. Home Depot up just over 2%. Johnson & Johnson was up about 1%. So some decent days there from some of those maybe second tier types of folks behind Microsoft and Apple. In terms of concentrated areas from a sector perspective, from my eye, it kind of looks like utilities had a tough day. As I look down below here in this utility area, looks like the vast majority of them were lower, with maybe the exception of American Water Works, but pretty much all the rest of the utilities were down or flat here today. We did see a lot of the financials lower today as well, so JP Morgan, Bank of America, Berkshire Hathaway, Morgan Stanley, Goldman Sachs, Wells Fargo, American Express, Capital One, a lot of those credit card companies did get a little bit of a downgrade here today. So that was an area that didn't seem to work out so well for investors today. In terms of concentrated bullishness, I'd probably throw healthcare into that discussion. You can see kind of in the lower left-hand corner here, most of these healthcare names were green today. I did notice that AmerisourceBergen was one of the worst performers within that sector, partially due to the news that Walgreens is going to be selling a substantial portion of the shares of AmerisourceBergen that they had owned previously. So that stock had kind of unique news there, but from an overall sector perspective, it does seem like there was more bullishness than bearishness there. All right, let's go ahead and pop on over here to the main part of the platform now. And let's check in on market breadth here today. And as you can see, I've got the index watch pulled up here for the S&P 500. And in terms of advancers versus decliners here today, it was a pretty split day where we had 288 of the stocks higher and then only 209 that were lower. So a slight nod towards more bullishness than bearishness. And again, remember, the market itself, the S&P 500, was down just a touch here today. And so similar to what I was mentioning on Tuesday, except the opposite in this case. Remember, on Tuesday, we had a day where the market was up, and a lot of it was because of the mega cap tech stocks doing pretty well. Today, it's kind of the opposite. The market was down, even though most stocks within the market were up, but because Apple and Microsoft and some of those like Tesla and others were down, they had a bigger influence on the final result. So you could say that the generals were wounded, but the army did advance a bit without them, and so that is at least a little bit of progress there. I think for a lot of folks, myself included, the big fear is we still have not seen a true wipeout type of a day. You guys have seen me, tweeting about this, I'm sure. Apologize if I sound like a broken record, but it's worth repeating. We have not seen a spike in the VIX yet. We have not seen long lower shadows yet. There was maybe just a touch of hope that we could have achieved that here earlier today with some of the indices, including the Dow Jones. You'll notice that we did have somewhat of a long lower shadow there. But the problem is we didn't really get that on other indices, and somewhat more important ones. Not to say that the Dow is not important, but where we're in the heart of the storm right now is in the growth stock area. Those are the ones that are getting absolutely annihilated. Those Cathie Wood types of stocks and other types of growth-oriented, innovative areas. Those are the ones that are down, 50 to 90%. It is just absolute chaos out there. And in the NASDAQ, you'll notice here that we didn't get much of anything in terms of long, lower shadow. Now, if we have a huge rally through tomorrow, I guess there is that possibility that on a weekly candle chart that could exist, right? I was mentioning that on Twitter today as well. So from a weekly candle perspective, that there's still a holdout there for hope. But a lot of times what we've seen in the past is that the long lower shadow actually happens on a daily candle, where it is just a devastating day where people just give up. Kind of like I mentioned here on Twitter a moment ago, we have not yet entered into the reverse stock split phase. We have not yet seen a lot of people just completely give up on the stock market. There's still hope out there, and I hate to sound like the bearer of bad news there, but we kind of need that. We kind of need to have people give up and just swear the stock market off forever, saying that it's a rigged game and that you can't ever make any money off of it, right? We need that type of just distaste and disgust with the stock market before we have some sort of a really serious bottom. Now, I'm hopeful we'll get some sort of a short-term bottom before too long. I'm hoping that within the next week and a half, we'll have the firepower to have some sort of a decent rally back towards the moving averages. Like I mentioned to you on Tuesday, I personally don't think we'll get beyond the moving averages, at least not for an extended period of time. So I do expect it to fail. But we are stretching that rubber band so much day after day after day that you've got to believe we're going to snap back in the short term. And, maybe as we head towards the expiration day next Friday for the May contracts, perhaps the market makers will be motivated to push the markets at that time. But right now we're all just kind of waiting in the wings. It's like I mentioned Tuesday, it's kind of like death by 1,000 paper cuts. This is not a market that has ripped the Band-Aid off yet. We're still waiting. Again, going back over here to the VIX real quick, the VIX was actually down today, right? The S&P 500 was down today, and the VIX was down, right? We're looking for the opposite. We want to see a huge spike. That will tell us that a lot of people are giving up, but we're just not seeing that yet. The VIX closed today lower, down at 31, on a day when the S&P 500 was also lower. That is not the sign of capitulation, right? It is, again, more of the same, where it kind of feels like the market has stuck the knife in, but they have not yet twisted that knife to actually finish the deal. So we're all waiting. If that happens, of course, we'll let you know here, but it just kind of feels like more of the same day after day with these markets. So to put a ribbon on it, we were down officially 0.13%. I'm sorry, 0.13%. Sorry if I misstated there a second ago. 0.13%. And so, in other words, less than 1% today. It was not a big sell-off day. And we did close fairly low, or fairly high off of the very lows of the day. The other thing that I would point out is that the S&P 500 is getting awfully close to being down 20%. I know David's been talking a lot about that on Twitter. He does a great job with kind of, helping folks understand where we're at in the grand scheme of things. But I know a lot of people are looking for that kind of 20% lower from the high number, and we're getting pretty close to that in the S&P 500. Of course, we've already surpassed it in some of the other indices. In fact, if those of you that are premium members, if you go over here to my trend trading chart 1A that we use in my Monday class, there's a label up at the top that can be helpful for that conversation that shows us how far away are we from the high. And with the S&P 500 right now, at today's close, we are 18.44% away from the high, which happened to be here on January 4th. So we're down nearly 20%, but not quite there. And there have been, throughout the last decade or two, a handful of examples of markets that have gone down 19% and they didn't quite go down 20%, and then they actually had a pretty substantial rally from the 19% level, almost as if they were kind of front running possible other algorithms that would have kicked in to possibly buy stocks when they were 20% off the highs. Who knows if that's the case, but it's just very peculiar that we have had a couple of instances of that over the years as well. But remember, the NASDAQ is a different ballgame. We pull up QQQ just to look at the NASDAQ 100 ETF to make it easy for us. Notice that that is down basically 29% from its highs. Now remember, you'd have to go all the way back here to November 22nd for that one. Remember, with the S&P 500, it topped out this year in January. For the NASDAQ, it actually topped out back in late November. It actually happened to be the exact same day that we sold our Microsoft shares in my top-down trend trading class at a double. We sold half of them and made the remaining half of the shares coffee can stock, and we extracted our original cost basis out of those shares and are now playing with the house's money. We didn't know it at the time. We just got darn lucky from a timing perspective. It just so happens that Microsoft and QQQ topped out on the exact same day on November 22nd. And since that time, the Qs have been down 29%. So again, for those of you that are newer, you should be aware that this market is being led lower by growth stocks. A number of the high caliber dividend growth stocks are still hanging in there. Coca-Cola and Procter & Gamble, those types of companies are doing okay. But it's really where the true selling and the extreme pain in the market is with those growth stocks that are in the technology space. Your NVIDIAs of the world and Salesforces. And, if you look at something like Tesla, technically it's a consumer discretionary stock, but it kind of plays a role in the tech space, as it were. So those are the ones that are really struggling the most. And part of the reason we've seen that kind of behavior is what's been going on with interest rates. As interest rates have continued to go up, tech stocks, as you discount those cash flows back to the current time, are going to have a higher hurdle to get over. And so they've really struggled. They've been given the benefit of the doubt over the years, but now they're being asked to prove it a little bit more, and they're having a hard time doing that. So you can see here on this chart, this S&P 500 purple line is higher than the price candles of QQQ. In other words, the S&P 500 is outperforming the QQQ. In fact, on a relative strength basis, the Qs have the worst score that you could have. This goes from 1 to 99 on this area down below, and so number 1 is basically saying it is vastly underperforming the S&P 500. Whereas if you pulled up, I don't know, let's say like a utility stock, one stock that we've had some exposure to in my classes is Southwest Gas, both from a dividend growth investing perspective last year and then here in real time in my trend trading class. And you can see that this is 99s across the board, SWX here. Now it's been aided by Uncle Carl Icahn and his rattling the cages there, but nonetheless, a sleepy old utility company seems to be doing much, much better than the super exciting growth stocks and technology stocks that are out there. So there are still some good-looking charts out there. I know it's probably hard for people to believe, but we will uncover them if they're out there, and we'll be talking about them in our classes, just like was the case here with Southwest, and hoping that one continues to work its way higher, at least for a few more months there. So anyway, it's been much, much more difficult in the growth-oriented area. And so that's where we would really like to see the sharpest snapback here in the near term, if at all possible. You can see that today the NASDAQ was up 0.06%, so call it flat. I did notice that the hyper high-octane growth stocks, like the Cathie Wood types of ARK Invest companies, were up. I was tweeting about that earlier today, where ARK was within $2. So let me pull up a longer term chart here. I'm just going to use the dividend stair-step chart, even though it's not much of a dividend payer, but just to prove the point of what I was trying to drive to with the tweet. You can see here that the ARK ETF, this is the flagship fund, ARK-K, it came down here to $33 even as its lowest point in the COVID drop. And then it went on its most spectacular run that you've probably ever seen out of a fund. And now it is effectively round tripped. I was talking about that a bit on Twitter earlier today when I was talking about this graphic over here. Now, this was a tweet that I had from back in February of 2021, so just over a year ago. But I was saying at that time that, I was starting to get a little concerned about the Cathie Wood effect, and I didn't think a lot of people were taking her impact on the markets all that seriously. I said, I think she's a bigger piece of the puzzle than a lot of people assume. And if the money keeps on flowing into her funds, the glamour stocks surge regardless of valuation. And we all know how that ends. It's like a game of musical chairs, and then somebody doesn't have a chair at the end. I said, if the money stops flowing, it could get ugly. So as a follow-up to that, I said, I think it's safe to say it got ugly. Anyway, not to pick on ARK, but the truth of the matter is they've kind of been the poster child of this entire run. And we've seen it go up dramatically, where it went from $33 up to $159. And again, nothing against that performance. It's amazing. There's an endless amount of adjectives that you could give it during that run. But we also knew at that time that valuations were just ridiculous and that they could likely not be sustained unless they truly did change the world. And even companies that are destined to change the world don't have to be profitable when they're doing that, especially in the short term. And we are now seeing the great unwind of that entire move. And earlier today, we were basically $2 away from breaking that low. So we came right down to it, and we did have a little bit of a bounce off of it. You can see that the ARK fund did close higher by 5.58% today. And you can see that a lot of people have probably been throwing in the towel as they just can't take the pain anymore. So at some point, those stocks are going to become quite interesting. And I have no doubt that if we have some sort of a dead cat bounce in the overall market, that these types of securities that are held by the ARK Innovative Fund are probably going to have some massive reversals. They might be up 15 to 20% within just a couple of days. But the problem is, after you've lost as much as this has, depending on when people got into this fund, right? The more that it goes up, the more that it attracted a lot of eyeballs to it. Sometimes I refer to that phenomenon with my students as, the idea of a bug going towards the zapper on a hot summer night. For those of you that maybe live in the Midwest or in the Southeast where you have a lot of mosquitoes or bugs, you know what I mean. There's those little, battery operated or perhaps electrical bug zappers that you plug in, and the bugs all go to the light. They can't help themselves. They just have to go to the light. And then it ends very badly for those bugs as they get zapped and they fall to the ground dead. That's kind of what's happening here, right? Everybody wanted to go towards the light, and the light was ARK Invest, because day after day after day, you were doing nothing but printing money. But now we see the flip-flop of that, where all of those bugs are falling dead to the ground. And so even if you did get, let's say, a 15 to 20% rally in a number of those names, so much destruction has already been created here that it's hardly even going to put a dent in recovering a lot of people's money. So it is pretty devastating there, and some of those names in the ARK Invest funds are unlikely to ever get back to their old highs. I know that sounds pretty dramatic, but remember, I also traded through the dot-com bubble where we saw a similar thing play out. And while some of them truly will change the world and might become the new or the next Amazons of the world, just like Amazon emerged from the ashes of the dot-com bubble, there will be a lot of others that just do not survive. Or if they do, they got to go through a lot of reverse stock splits and raising capital and diluting shareholders, and it could literally be years, if not decades, before some of those stocks get back to their previous highs. So it's been interesting. It's been a good environment to learn, and I hope all of you are open-minded enough enough to, learn from that, learn from other people's mistakes, learn from your own mistakes as well. And I include myself in that conversation. Obviously, there's plenty of things I could have done better as well. And we're constantly trying to get better each and every day as investors. But it has been a unique period throughout history, without a doubt. So back here to the 4 grid. S&P 500, still strongly bearish posture. In fact, that's the case with all 4 of these, right? When the background color of the charts on this chart 4B are strongly, they're dark pink, that's considered strongly bearish posture according to the market forecast technical indicator, right? That's not my opinion. That's actually what the indicator is telling us. That's how you interpret it. So right now we continue to be in strongly bearish postures on all 4 of these charts, and we still have not had that big violent sell-off where the VIX spikes and we end up with a long lower shadow. It's not a guarantee we'll get it, but more times than not throughout history when we've had these devastating kind of bleed off markets, it does require some sort of a huge washout day like that before we start a big recovery. So we still got work to do, in other words. The other thing I would point out is not only do all 4 of these charts have strongly bearish postures, but similar to what I had mentioned to you guys on Tuesday, all of them have these pink labels showing up here as well. In other words, we hit 52-week lows on all 4 of our major U.S. equity indices here today. So although the NASDAQ composite and the Russell 2000 both closed higher, the Russell was actually up over 1%, so that's a good sign. But at some point during the day, they fell low enough to eclipse their prior low. So that's why we see these low tags underneath the candles of today on all 4 of our charts. So not a great day from that perspective. One thing that is a little bit different from Tuesday is that we no longer have our cluster signals. Notice that the 3 dots that we have down below were from the 3 previous days, not today. And that was the case for the S&P 500. With the Dow, it was a little bit different because it only had 2 previous clusters. But again, today you do not have one. Down below on the NASDAQ, you had 4 days in a row of clusters. Today, you don't have one. And then on the Russell 2000, you also had 4 days in a row of clusters. And today, you do not have one. So like I mentioned on Twitter on Tuesday, after I got done doing the video, I took a screenshot of this 4 grid and I said, today was somewhat unique in that we got all 4 of our equity indices with 52-week lows and all 4 of them with oversold cluster signals on the same day. And that kind of, took me by surprise because, you guys know that we've been doing these videos for years and I don't recall the last time that happened. And I said on Twitter, it was probably back during the 2020 COVID meltdown would be my guess is the last time that occurred. And so it was somewhat rare and surprising to learn that, yes, we are now down on a rolling 12-month basis on all of these major equity indices. And all of them are extremely oversold right now, and we're just waiting for a catalyst to rip that market back towards those falling 30-day moving average where we can then reposition a little bit again. So anyway, Dow was down 0.33% today. So Dow and S&P 500 down just a touch. NASDAQ and Russell 2000 were up just a touch. The NASDAQ and the S&P 500 actually had above average range days. So that's kind of what I was driving to with that comment I made earlier in the presentation, where don't let the end result of today fool you. You look at the S&P 500 and you kind of put your hand over your mouth and yawn a little bit and you say, okay, was that all there was? Just a 0.13% move? But the truth of the matter is we actually had a pretty healthy range between the high and the low here today. The daily range today was slightly more than the average true range. So despite the end result looking flat, we actually had some pretty good volatility throughout today's session, both on the upside and the downside, even though we kind of just closed at the flat line. All right, let's go ahead and step on over here to the internet briefly. I always like to get a chance to say thank you to those of you who helped support this free presentation. And wouldn't you know that when I did the video for you guys on Tuesday, exactly 100 of you clicked like. If one of you that clicked like did not click like, I wouldn't even be talking right now because this video would already be over. Remember, if we're under 100 likes, I'm just going to do a 15-minute quick hitter video only on the indices and not including a trade application example. So that's how important each one of your likes was the last time around. You guys are cutting it pretty close. But, that's, like I say, I always let you guys vote. It is entirely possible. You guys are getting sick of these longer form videos. They've been, close to an hour for, months at this point as I've been doing them. And remember, that's only part of what we do. These videos do take at least 3 hours. In recent times, it's been more than 3 hours. In fact, most days on Tuesdays and Thursdays, I don't even get to eat dinner with my family. I'm not trying to make you feel bad about that or anything. Obviously, that's a decision that I make here, but just to let you know, it is disruptive, right? When we do these videos after the stock market closes and we're trying to put a good effort into them, it does require sacrifices. And obviously, we want to make sure that our sacrifices are worthwhile. And the way that you guys can let us know that our sacrifices are worthwhile is simply by clicking like. Remember, we don't require you to pay us for this or anything along those lines. We don't make any money off of this. We don't make money off of advertising or eyeballs or anything along those lines. So this is all just free goodwill that we're heading in your direction. So again, as always, if you want us to continue to do these for free as often as possible, we have one simple request. Just take 5 seconds out of your day and click like for us. And thank you to the 100 people who did that for me on Tuesday. All right, let's go ahead and also take a look here at some of the content that we had on a premium side of the company here today. I had my question and answer session, and then David taught his portfolio management with ETFs class. In terms of some of the content we covered in my question and answer session, I had another conversation about Series I bonds. Some of you have been reading about those recently, and those are inflation adjusting bonds that are at basically the highest levels since their creation. Those particular bonds were created back in 1998. And the current rate at 9.62% is the highest rate they have ever offered. And last 6 months period that just ended here at the end of April, where they were just over 7%, was the second most they've ever offered. So we are currently dealing with the highest interest rates on those government Series I bonds that we have ever seen since their creation in 1998. So we had a good conversation about that. We had a conversation about a self-storage REIT. Cube is the ticker symbol, and my thoughts on whether they would be a good dividend growth investing candidate. I had another student ask me about his routine and wanted my feedback upon his routine about, filtering the CCC spreadsheet and, looking at some of these different metrics that we like to look at as dividend growth investors. I also got a question about evaluating Altria as a dividend growth investment stock and my philosophy on, that somewhat controversial business model. And then also had a question about how to create advanced orders for swing trading purposes, both on bullish trades and on bearish trades where we do short selling ideas there. So if you're interested in that content and you're a premium member, the recording to that class is posted on our calendar. Also, while we're over here, let's have a little chat about the factor selector tool. And as you can see here, we didn't see a whole lot of change week over week. Now, this is a couple of days old right now, so there, that maybe a few things have changed yesterday and today, but probably not. It's probably been about the same. So what we know at this moment in time is that where there is any semblance of capital preservation, it is happening in the higher quality dividend yielding companies that are out there. This is a market that has grown concerned about growth stocks and feels more comfortable hunkering down in defensive blue chip companies. On the flip side, momentum continues to be dead last. So momentum or price chasers, right? Folks that are looking for the next great thing, they're more times than not jumping aboard a train that is about to come off the rails. And so momentum chasing and price chasing has not been a great strategy in this particular market environment. In terms of any movements we saw week over week, we just had a minor movement between quality and low size. Low size, obviously a little bit more of a speculative area with those small cap companies, and so they've been struggling in this market environment. Quality got a little bit of a boost there week over week. So again, not too much change here week over week to discuss. We're seeing a lot of the same trends. Blue chips doing well on a relative basis, and the MOMO stocks, the momentum stocks out there, still struggling on a relative basis. All right, let's get back on over here to the platform and let's do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And as we pull this up here, boy, we're losing them left and right, aren't we? This is the least amount of green squares that we've had, in quite some time. I don't remember the last time we only had one green square show up on this asset class 12 grid. So a reminder for those of you that might be new, the green background colors, like we see down here with the US dollar, suggest that we have a strongly bullish posture on it. When the charts are pink, we have a bearish posture, either strongly bearish if it's dark pink or weakly bearish if it's light pink. So this is kind of an odd situation where only one out of these 12 charts is green. It is less odd when we're looking at, let's say, the sector 12 grid. And the reason for that is all of those are stocks, and sometimes stocks are highly correlated, either all to the upside or all to the downside. But this first set of 12 grids is intentionally oftentimes different from one another because they are covering such a wide variety of asset classes. So it is very rare to see 11 of these 12 squares in one color and only one in the other color. So again, it was the US dollar that retains its strength. It was up another 0.86% today as the euro really struggled. So for those of you that are looking to take a European vacation and you reside here in the United States where you make your paycheck in US dollars, that paycheck is going to stretch a little bit further at this moment in time. The dollar has not been stronger than this in a long time. You can see dollar up here at the top of this chart. In fact, it's so strong that for the last 2 days, we've had these overbought cluster signals. And remember, that doesn't happen all that often with the world's reserve currency of the US dollar because it usually does not have extreme movements. Remember, the overbought and oversold cluster signals usually occur on extreme charts. And because the US dollar is so liquid, you usually don't have extreme in either direction. So it's pretty rare to see a couple of overbought cluster signals in that case. And whether that slows down the ascent or not is anybody's guess. But right now, what we can say is this is a very strong chart that we are dealing with the US dollar. What had been the case in most of recent weeks and months is that in the other corner over here on the lower right-hand corner, we had normally seen strength there with the 10-year Treasury yield as well. But we've actually seen interest rates pull back 4 days in a row now. And while the interest rate, at least the 10-year, is still above its rising 30-day moving average, you can see it's still colored green there. So if it had closed below it, that moving average would be colored yellow on its tip. So we closed just a hair above that rising moving average, which means there's a decent chance that it'll try to establish some sort of a bounce from here. But it has been a pretty aggressive move. Notice the separation between the price candles of TNX and the 30-day moving average since this point in early March. There has been a ton of separation. There's been a lot of space. And then all of a sudden you close the gap. You just shut it down with 4 straight sell-off days right there. So we've had a nice little run in TLT. So bond prices have gone up at the time when interest rates have gone down. But we're in a unique period right now where both of them actually end up having a bearish posture. That something will give there, right? That won't stay the case the entire time. One of those two will switch back to a bullish posture. So this is a kind of a rare event when you see something like that happen. If you believe in trends, then you're probably going to, make the case for TNX to find a bounce up and off of that rising moving average right there. In terms of our commodities, we did have oil go higher here today, so it was up just over 1%, and oil hasn't lost its trend. What it's done is it's kind of slipped into more of a sideways pattern, but it hasn't necessarily slipped into a downtrend, right? And we can make that case with gold. Gold was in an uptrend, it rolled over and is now truly in a downtrend. You can see that that 30-day moving average remains red, so price is below that falling moving average, and we've had that strongly bearish posture here for a while as well. Oil does not look that way. It's not to say that it won't in the future. There's a lot of folks that feel like eventually when this market needs to bottom, it's going to take everything down with it, including the once hot oil trade. So we'll see if that happens or not. But right now, oil is at least hanging in there. It might not be as strong of the trend as it once was, but it's still trading above its moving average. So again, you kind of want to give it the benefit of the doubt when it's been one of the bigger winners of the year. Remember, oil is still up 19% over just the last 3 months. So while this has maybe felt a little bit disappointing to see the sideways action, really it's just kind of burning off the fat because it went up so much early in that 3-month period. It just needed to kind of go sideways to kind of cool off a little bit. And it could easily start producing some strength from here once again. Bitcoin had a volatile session. As it stands right now, we're at about 28,000 on Bitcoin. And so as I mentioned on Tuesday, it was quite the violent rug pull from basically 40,000 down to 30,000. It seemed like that happened, in a heartbeat. And we did have wild trading on Bitcoin today. There's been, a lot of kind of controversy in the crypto space. I'm not an expert there, so don't ask me the details. All I know is that some of the so-called stable coins have basically been unraveled, and some of the things that were expected to occur did not. And therefore, there's been a lot of chaos that's been flowing through into the crypto space. And it's not just Bitcoin that is suffering here. All of the big players, Solana, Ethereum, all those big players are just getting smashed right now. So the fact that Bitcoin kind of stabilized today and kind of held the line is maybe somewhat hopeful there. And if we do get a big rebound in, let's say, the NASDAQ in the next couple of weeks, I would personally anticipate that Bitcoin could also rip higher in that environment. The Bitcoin, it kind of takes its cues from the NASDAQ and vice versa, it seems to me. So be on the lookout for that possibility there. In terms of our upper charts, you'll notice that they're all red as well. And we had sell-off days in the foreign markets, which should not come as a surprise. Remember, all else being equal, when the US dollar is strong, foreign assets are going to struggle comparatively. And so today we did see EFA, which tracks our developed foreign stocks, slightly underperform the U.S. stock market, so they were down 0.24%, and then the emerging markets were down a little bit more violently. They were down 0.66%, so not dramatic, but just kind of continuing that theme that I had mentioned before, which is it just feels like day by day by day, death by 1,000 cuts. It's not one of those where we just see this big whoosh and then recovery. We're all kind of just waiting for that, and we're just not quite there yet. All right, let's go ahead and now take a look at our Sector 12 grid. This will be chart 5C. And so as we're looking at this, here's kind of what I was referencing before, where this is not entirely surprising. When we're looking at sectors, they are all stocks, right? When we're looking at the asset class 12 grid, we're looking at bonds and cryptocurrencies and regular currencies and commodities, and the chances of all those things going in one direction at the same time are somewhat rare. But the chances of all sectors going either up together or down together is a little bit more likely, and that is kind of what we're seeing right now. Notice that we do have pink charts across the board here on these market cap weighted ETFs, and as you can see, the only one that has a slight difference is the energy sector, which is light pink as opposed to the dark pink colors of all the rest. And so that basically means that we have a weekly bearish posture on energy. For all of the other sectors, they are considered to have strongly bearish postures according to the intermediate line on the market forecast technical indicator. And most of the charts do not look healthy at all. In fact, the only chart that has an upward ascending 30-day moving average is energy. That's it, right? With this green tip right here, it looks a lot different than everything else on the board. All of the other charts have red tips. In other words, price is below falling 30-day moving averages on 10 out of the 11 sectors. that is a very uncomfortable feeling for market participants. And remember, the market cap weighted ones could have slight differences with the equal weighted ones. We talked about that a little bit on Tuesday, but nonetheless, this gives us a good feel for why there is so much stress in the system right now for folks that are dabbling within the S&P 500. You just cannot avoid the carnage unless you are just filled to the gills with energy stocks, and even that has started to be called into question here a little bit more recently. So it has been really, really tough sledding out there. Now, for today's trade application example, some of you who are premium members already know the trade that I did because I sent it out via Telegram, as I always do, and I did the trade about a half an hour before the market closed. And at that time, the S&P 500 was actually down over 1%. We actually had a pretty solid rally for the final half an hour of the day to get us basically close to break even. But with a half an hour to go, we were down 1%. And most of you know that when we are down 1% or more in the markets, I like to enact the strategy known as selling puts. And so that is what I did yet again today. And some of you are probably groaning right now because you're thinking to yourself, Brandon, you should try some other strategies once. It might suit you. And I get it. I understand. But the truth of the matter is, I've never been this concentrated in sold puts for this particular video for the last several years that I've been doing it. Remember, David and I have been doing this market outlook video since we started Market Scholars 4 years ago, but we were both doing the video called the Market Forecast video when we were with our prior company over at TD Ameritrade in the years prior to that. So I am telling you right now, I have never had such a high concentration in one single strategy as I do right now. And some of you are probably thinking, is that concerning to you with the market constantly falling and you doing bullish trades? Have you started to get nervous about that? And at this point, I'm still feeling reasonably good about where we stand. If we come over here to the Monitor tab, you'll kind of see where our open positions are at this moment in time of all these trades that I've done in this free YouTube video for you guys in recent weeks and months. And most of them are sold put trades. And so let's do a quick little review, because I think sometimes people take things a bit too far and assume that you're just having just a terrible experience if you're doing bullish trades in a market that constantly goes lower. And I like to remind folks that does not have to be the case. If you have careful selection of what you're doing, you can still have reasonable success. So remember, where we get into hot water when we're selling puts is when the stock falls below the strike price that we sold. It's at that time we have the responsibility of buying the stock, which is not the end of the world if you really wanted to own it for the long term. But obviously, if that stock were to plunge in price, you might have second thoughts about whether you want to own it or not. So it kind of has some catch-22 aspect to it there. So let's kind of go through some of these, where we stand right now with these sold puts. Whirlpool is down here. You can see that we sold the $140 put. This is a May contract, so it expires next Friday, and we sold the 140 and it's trading at 182 right now. So do you think I'm sweating that trade all that much? No, I'm not asking for trouble either. Sometimes you got to be careful because the market likes to serve you a nice helping of humble pie every so often. But right now, if you ask me truthfully, do you expect Whirlpool to fall $42 per share in the next 8 days? I would say no, I do not expect that. So I think we're in pretty good shape on that one. Texas Instruments will skip because remember, Texas Instruments was the rare bearish trade I have on right now where I sold a bear call spread. And of course, we're making money on that trade. That makes sense because the markets have been bearish. I did a bearish trade there and we're winning some money on that trade at this moment. But again, going back, and again, you can kind of see that this is the delta column here, by the way. All of these that you see are positive deltas except for that Texas Instruments one. In other words, all of the trades I've done are bullish trades except for Texas Instruments. And by the way, it's not that I haven't wanted to do more bearish trades, but my problem is I want to wait for a recovery in the market and then put on new bearish trades. I'm a little bit fearful putting on bearish trades right now if I'm expecting some sort of a quick reversal to the mean, right? Because I could get knocked out of that trade relatively easily. So believe me, I'm waiting to do more bearish trades, but I'm hoping that the stock market rebounds a little bit before I put those trades on. But anyway, Stanley Black & Decker. is the one we'll be talking about for tonight's video. You can see up here with the execution price, I got filled at $1.15 by selling the $95 strike for the month of June. So that one we just put on, but so far so good, because like the rest of the market, that one did recover in the final half hour of the day as well. So we're already making a little bit of money on that one. Scott's Miracle-Gro, that is another June contract, so it expires in 36 days. $75 put is the one that we sold. It's trading at 95 right now. That has been a more volatile security, right? It has a little bit more juice behind it, both on the upside and the downside, but still, we have $20 worth of wiggle room before we get into hot water there. It would need to fall $20 more in the next 36 days before we start getting into trouble. Starbucks, we sold the 65 put. Now remember, this was the rare weekly contract that I sold. Normally I do monthlies. This one I specifically wanted to target 65 because that's where it would have a 3% dividend yield. And it's trading at about 70 right now. So this is one that's getting a little bit closer, that we are going to have to keep our eye on a little bit more. It has fallen a bit more than I would have anticipated. But even still, I actually like Starbucks at $65 per share. If you can lock down Starbucks with a 3% dividend yield and hold it for the next 10 years, I think you'll probably have a pretty good experience as an investor. But then again, I could be wrong. But the point is, we still have $5 more before we are getting into any real pain with that one. The Qs I put on here more recently. This one's a little different because unlike all the others that are dividend stocks, the Qs I just put on because of the oversold conditions. So with this one, if it were to fall down to 260, I would likely be looking to do some rolls there. And of course, if we do that, I will let you guys know via the Telegram app who are, premium members of our service. But right now, that one's at 291, so it would have to fall $31 more before we get into hot water. But, that can happen on the Qs because it has been moving more violently. So we're going to have to keep a closer eye on that one as well. Phillips 66, that one expires next week in 8 days. We had sold the $55 strike. It's at 91 right now. So again, similar to Whirlpool. Do you think it's going to fall $35, $35, $40 per share, whatever it is, in the next 8 days? I highly doubt it. So we did a bullish trade, and it's doing just fine there for us. Polaris is the next one. That one also expires in 8 days. It's trading at 105. Our obligation is at 80, right? Is it going to fall $25 per share in 8 days? I doubt it. Kellogg is a little bit of a unique situation. This is one that we did quite some time ago as a leaps almost experiment when we sold the put on that, and we've done really, really well on that particular trade. But that one does have 253 days to go, so who knows if things really move against us there. But right now, obviously in good shape with it trading close to 73 and our obligation at 50. Remember, Kellogg is one of those consumer staples companies that's actually benefited from this chaos of the markets here more recently. The next one on the board is JP Morgan Chase. Our obligation is at 105. It's trading at 118. This one has struggled a bit more than I would have assumed. It really hasn't caught much of a bounce here recently, so we'll have to keep our eye on that one. But right now I'm still feeling reasonably good about the distance between those two. It would have to fall an additional $13 per share. And then up here we've got Comcast that's next. It's currently trading at 41. Our obligation is at 35. That's another June contract with 36 days left on the board, so we still have to keep a closer eye on that one as well. But again, we've got a $6 head start. And then the last one up here is Best Buy. That one expires next week, so only 8 days left on that one. It's trading at 87. Our obligation is at 80. That one snapped back nicely today, but it was getting a little bit closer to 80 yesterday, so that's another one we're going to have to keep an eye on it. But the point that I'm trying to make by showing you all this is all of those trades, except for one, were bullish. And I didn't even include the TAP trade that I did on Tuesday's video. Remember, that was a little different because it wasn't an options contract. That was a swing trade to the bullish side of the coin. And by the way, I saw that their CEO got interviewed by Jim Cramer here tonight, so maybe we'll get a little bit of a bounce tomorrow morning based upon that interview. But again, we have nothing but bullish trades in here except for Texas Instruments. And I'm not feeling particularly concerned about them because of how much distance there is before we get into hot water with them. And again, it's not to say that they won't get into hot water. They could. If the markets continue to spiral lower, some of them could start giving us some heartache. But right now, I would say they are in reasonably good shape. And part of the reason behind that, so I would say that the reason behind the success of those trades, and let me pull up the chart of SWK while we're talking about that, so that way you guys can see that as well. So SWK is Stanley Black & Decker. This is the one that I did today. And you can see that it has sold off into the blue zone of the dividend stair-step chart, meaning that it now has an attractive yield compared to its historical yields throughout the last decade. You can also see that it has an oversold cluster signal there with that little green dot showing up, meaning that there could very well be some sort of a snapback recovery here in the short term. You can also see down below that its valuation is quite cheap. It's trading at 11 times earnings right now, basically 12, 11 times earnings, somewhere in that general vicinity, which is pretty much the second cheapest this stock has been in the last decade, with the only exception being the anomaly of the COVID crisis in 2020. And the strike that I sold, as you saw earlier, was the 95 strike for the month of June, which would put us all the way down here, which would mean that this current 2.62% dividend yield would then amount to well over 3% dividend yield if the stock were to fall from the current 120 down to 95, and thus forcing us to take ownership of it down there. This is a dividend aristocrat company. In fact, it's a dividend king as well, meaning that it's got more than 50 years in a row of dividend increases. But in terms of why have we been able to have success with hardly any bearish trades and doing this particular strategy that is bullish, I would put it down to three different specific aspects. First of all, we're not trying to be cowboys here. We're trying to sell these far enough out of the money where we can afford to be somewhat wrong with our decision. So what I tend to teach my students to do is to look for the 1% return on risk or thereabouts. So for instance, the way that you kind of can reconcile that in your head is, today we sold the 95 strike and we got $1.15 for selling that. So if it was 95 cents that we got for it, it would be exactly 1% return on risk. So $1.15 is slightly more than a 1% return on risk in that particular case. So that's one thing that we can bank upon as we've had some success here, whereas I'm sure there are tons of other put sellers out there that are just getting mauled by the market right now. They are probably selling strikes that are too close to at the money. The other thing that I think we've had some success with is selling puts on the right types of stocks, right? Going back to what I had mentioned before, other than the QQQ, which was a unique situation as an ETF, all of the other stocks that I sold puts on are dividend growth stocks, many of them old school companies like Stanley Black & Decker, right? We're not messing around here with Tesla. We're not messing around here with Zoom Video or with Teladoc or some of these crazy, innovative growth companies that have been just demolished and down 50, 60, 70% types of things, right? We're concentrating on old school businesses that have lots of cash flow. And then the third thing that I would point out where we've had some success in doing a bullish strategy while the markets have been so bearish is that we are transacting these trades on big down days for the market. And again, remember, when I did this trade on Stanley Black & Decker earlier today, the market was down over 1% because I got to get the trades done before the market closes. So I usually do them about a half an hour. And I don't know what's going to happen in that final half an hour. The market could have gone down even further, but instead it snapped back. So, but normally when I'm doing these sold put trades, I'm doing them on days when the market is selling off somewhat violently, which means that I have a heads-up advantage over other folks that are doing similar strategies because I'm juicing my results. Because on days when the market is getting punched in the gut, volatility is likely up. And remember, volatility is one of the three main pricing components of options contracts. And so when you're selling inflated volatility with the hopes of that eventually becoming deflated in the future, whether you know it or not, you are somewhat benefiting your situation there. And this is effectively the strategy that I teach to all of my premium members in my Monday afternoon class, Options for Long-Term Investors. What I'm showing you here is effectively the same type of thing that we do every single week in that particular class. So if you're interested in learning more about this approach and you like the idea in general, of course, we would encourage you to become premium members members and join us in that particular class. So that's what I had here for you tonight, an oversold cluster signal on a dividend king that is now entered into attractive yield territory where we were able to get a fairly attractive premium for selling well out of the money strike to give us the flexibility of being wrong in the short term as long as we're not violently wrong. If you got value out of tonight's conversation, I ask one simple question or one simple request out of you, and that is to click like for me there on Twitter. As long as we're up and over 100 likes on Tuesday, the next time I'm scheduled to do the video, I'll do another full-length video, including a trade application example like I just showed you here with Stanley Black & Decker. If we're under 100 likes, then there will be no trade application example, and I'll just make sure that it's a quick hitter video for those of you that want a more efficient video that would only be 15 minutes in length and would only cover the 4 major U.S. equity indices. So, until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.